wondering if it's becoming harder to have conviction on, given what Jay Powell said yesterday.
I think it's a reasonable concern, given what Powell said, and also given today's data, particularly retail sales. We sold off very hard on the retail sales number. But the Atlanta Fed did revise down their GDP tracking model for the fourth quarter from over 3% to 2.8%. But what's fascinating is they didn't cut the growth rate and consumer spending all that much. They cut it, I think, from 3.7% to 3.4%. I think it's because a lot of the weakness in retail sales was in pricing. Consumers had a buying binge in the past couple of years, and now inventories have piled up and companies have had to discount their inventory. So I think that's a good story in terms of inflation coming down, and I think they are selling the merchandise. And so I think the unit sales are going to be pretty good. Housing, we've got some real weakness in single family, but multifamily is doing extremely well. Stephanie Links and others on your show have pointed out that there's a tremendous amount of fiscal stimulus in the pipeline, much more so than we've ever had in the economy. Usually stimulus comes late in a recession, early in a recovery. We've never had this kind of stimulus in front of what everybody fears is going to be a terrible recession.
Yeah. Let me ask you this. Was the Fed more hawkish in its outlook yesterday than you expected?
Yes and no. I guess the optimist in me hoped that they would give a little bit more weight to the fact that it certainly looks like the CPI inflation rate peaked in June and continued to moderate right through November. That's a big deal, in my opinion. And I think it's going to continue to moderate. But I think because the Fed was so late to the game in raising interest rates, now they may be a little bit overdoing it. But look, I think the economy is going to prove to be remarkably resilient. I think it can handle 5.25% on the Fed funds rate. I am kind of challenged in that view by what's going on in the fixed income markets, because as you know, we're down to like 4.2% on the 2 years. So that's signaling the rates will drop next year, whereas Powell is saying he's going to keep it at 5.25% through the end of next year.
Even if they do pause or pivot, as perhaps the bond market may be suggesting they ultimately will, isn't that a negative? Isn't that they would do that because they'd be forced to by the fact that the economy is actually starting to tip over? And I would challenge you on the notion somewhat that the economy, in your words, I believe, as you put it, can handle 5 to 5.25% on the Fed funds rate. Do you really believe that, and how?
I do, because when you look at past business cycles, recessions were really caused by the Fed tightening, which is what's happening now, and the yield curve would invert, which is what is happening now. But what's different this time is we've had financial crises that haven't morphed into an economy-wide credit crunch, which is in the past is really what caused recessions. So I need to see more signs that the credit system really is challenged, and it looks pretty strong. It looks like it can handle 5.25% on the Fed funds rate without a problem. We had a cryptocurrency meltdown, we still do. We had a lot of these speculative stocks melt down. I would say that bond market bubble is an example of the extent to which the market and the economy have been able to handle this kind of stress really remarkably well. One more point, Scott, and that is it'd be very unusual to have a recession when the labor market is this tight. I'll admit that the unemployment rate usually is at a record low or a cyclical low before recessions, but we've never seen a scenario where the economy is got such a very strong, hot labor market. How do you get a recession out of that? I think the consumers are seeing their wages finally going up faster than prices. I think the payroll employment remains strong. I think the consumers will continue to spend. They're just pivoting to services.
Because it's a lagging indicator, as you well know, and the more leading indicators are more negative than the job market would suggest the economy is.
Yeah, let me just say the payroll employment is one of the 4 components of the index of coincident economic indicators. But you're absolutely right that in February of this year, the index of leading economic indicators peaked, and it's been falling right through November. And that is a concern because it has an awfully good record of anticipating recessions. But I think what's missing, as I said, is the financial system is in much better shape this time around, and I don't think it's going to trip up the economy.
We'll leave it there.